Encouraging home purchase signals this week, even as mortgage rates have stabilized around 7%. Available inventory of unsold single family homes rose 2% this week. Last year, it rose 6% in the week. The price of the homes going into contract is holding up each week. Last year at this time, the few homes that were getting offers were doing so at much lower prices each week. This is a dramatically different housing market than it was a year ago. And it tells us two things. One is that home buyers may be more sensitive to changes, rapid changes in mortgage rates, than they are to the absolute levels. So when the rates are stable for a while buyers settle into what they can buy. And then when the rates change abruptly, suddenly, as a home shopper, my calculations all change and I stop. So the second thing that we learn now is that the year-over-year comparisons start to get much easier in the data from here on out. So we'll start to see inventory decline year over year. Prices appreciate year over year. Fewer price reductions from last year. And even if we're lucky, by the fall, more home sales than the year previous. Every week, of course, Altos Research tracks every home for sale in the country. We analyze all the pricing, all the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. We've been looking in the data to see how fragile this real estate market is in the face of consistently higher mortgage rates, and why now it seems like it's the rapidly changing moments that are the real risks, and the stability in the time purchasers start to resume. I'm Mike Simonsen. I'm the founder of Altos Research, and let's take a look at the data, the peak of the home buying season at the end of June 2023. This week, there are 459,000 single-family homes available on the market across the country. That's up 1.9% from last week. It's still 10% fewer homes on the market now at the end of June than there were over the New Year's holiday this year. So normally by mid-June, you'd have 10 or 20% more homes on the market than over the holidays. But this year we have fewer. In this chart, each line is a year, and with the curve of the available inventory for the year. This year is the dark red line, and we're almost halfway through the year, of course. We started 2023 with 80% more homes available on the market than the year previous. And now we're just fractionally more. Next week, we'll have fewer homes on the market than last year at this time. Just a dramatic change from the start of the year. This chart is handy to see where the rest of the year will play out. We have 6 or 8 more weeks of rising inventory, or it could be as many as 3 months. But unless mortgage rates spike like they did last summer, we will finish 2023 with 10% or so fewer homes on the market than we started the year. And it's in years like this where demand exceeds supply. This is a good rule of thumb for home prices to project that home prices will increase another year out in the future. So that bodes well for home price strength in 2024. At these mortgage rates and at these home prices, which are dramatically less affordable than they were 18 months ago, we still have demand that exceeds the restricted low supply. Last year in June, of course, inventory was climbing by 6% per week as demand had stopped cold, and the last of the sellers in 2022 were hoping to squeeze in a sale. Last year, the changing market pulled supply forward into June. In June last year, we were seeing each week 100 to 120,000 new single-family listings on the market. That's not historically a lot, but it was the peak for the last year. This year, there's no peak. Just very few sellers in a supply-constrained market. So just 84,000 new single-family listings this week. Of those, we saw 21,000 immediate sales, those going into contract immediately after listing. Each bar in this chart is the total count of new listings in a week. The taller the bar, the more the supply. And you can see how dramatically less supply the market has been getting this year compared to last year at this time. The light part of the bar are those immediate sales that went into contract immediately after listing. The rate of the immediate sales actually had been falling as mortgage rates jumped from 6.5% to 7%. So the change, but it seems that the immediate sales rate has stabilized this week, and it makes me wonder if consumers aren't more sensitive to the changes in the mortgage rates than to the absolute level. Mortgage rates are higher than they were a year ago, but they're stable now for a month. So last year, rates rose so rapidly that the market froze solid. Then homes started moving a bit in July and August. Then rates jumped again in September, and the market froze again. So by January, home buyers had adjusted to the new normal and started buying again. So it's the change that it seems like that consumers are most impactful. And we've had these really big changes. So it's something to keep our eye on as we go forward. Because we saw a few more transactions this week, we also see that fewer sellers need to take a price cut. So they're now 31.6% of the homes on the market that have taken a price reduction. That's fewer now than in 2018 or 2019, and it's a totally normal range. Last year, price cuts were accelerating dramatically each week, and this year we have much more demand. We have much more stable. It's demand greater than available supply each week, and so the price cuts just aren't really accelerating. The market will have fewer price cuts than last year in just 3 weeks from now. Last year, the light red line you can see was just skyrocketing at this point. The slope of the line is what tells us so much here. The data, looks at the whole market, all the homes on the market. So the steeper the slope, those are the new price cuts that happen in a given week. And you can see the yellow line in 2020 here at the beginning of the pandemic when demand was accelerating. So the price cuts were falling in the middle of the summer, which is actually very unusual. Price cuts show us now a much more balanced market than any of the last 3 years. And remember, that it's balanced at these prices and these mortgage rates. There are no signals anywhere in the data that home prices will fall this year. If you're one of those people who assumes that affordability challenges means that home prices must fall, there's just no sign anywhere that home prices are filling that narrative yet. So that's something to keep in mind and to keep your eye on in the data. The median price of single-family homes in the U.S. is unchanged this week at $455,000. That's a fraction lower than last year at this time. Last year, the median price started falling quickly in July, and then at the end of June is often the peak pricing week. And in fact, usually you can see a few more weeks at this price plateau. You can see the peak last year was really quick. And this year might be more stable for a few more weeks before the market changes in the second half of the summer. All the price signals show us that home prices are not falling. And in fact, some are starting to point to the fact that we could end 2023 with positive year-over-year home price changes. For a year now, we've been pointing out how home prices for 2023 would likely be flat from 2022. Sometimes the data looks like that's optimistic. Right now, that actually looks pessimistic because some of the signals are surprisingly positive. I suppose that if sometimes we're up and sometimes we're down, we should probably hold the line on a call for flat home prices for 2023. The light red line here is the price of the new listings. That one bounces around a lot more than the overall market. And this week it ticked down 2% to $410,000. The price of the new listings is important to watch because it'll tell us signals of, like, if the signals of demand shift very quickly. Last July, the price of the new listings, you can see a steep dip, fell 5% in just 2 weeks in early July. So keep your eyes here to see the demand trend for the rest of the year. Prices will tick down in the second half of the year. That's what they do. But we're going to look for big jumps. They've been pretty small so far in the price of the new listings. Here's another view of prices that in this moment, it might be the most illuminating that we have. The median price of the homes going into contract each week is now $383,490. That's up a tick from last week and 3.6% higher than last year. The price of the new pendings here has been below last year since March. So the homes going into contract have been cheaper than the ones last year. And so these are the homes going into contract, so they typically close in 30 to 45 days. So notice how this year's dark red line was lower than last year, and that now is above last year for a few weeks in a row. And so last year's big home price adjustments happened in July and again in September. That's when mortgage rates jumped. This year, we're not looking at those price corrections at all, though. So the year-over-year price comparisons get much easier, and that's what I mean when I say that many of the home price signals are bullish, like starting to look bullish for the rest of the year. What a surprise! The end of June is always a transition point for the housing market. This year, you'll see the headlines start to change too. The basic fact remains true that home buyers and sellers need to know what's happening right now. They have a lot of opinions and there's a lot of noise to filter. So they need you to communicate about the actual data right now. And so if you need to reach home buyers and sellers about the active housing market, go to altosresearch.com, book a free consult with our team. We'll help you interpret the crazy market for your clients, your local market. It's a critical time to be properly informed, so please join us.